Welcome to another explainer. Man, if you've been watching the ticker lately, you are probably feeling a little bit of whiplash. It has been a truly chaotic week in the markets. Today, we're going to unpack all of it. We're going to figure out how massive national debt milestones are intimately connected to sudden AI stock dips, and incredibly, how all of that ties back to a cancer vaccine breakthrough. I know, it sounds like a totally random puzzle, but stick with me, because by the end of this, you'll see exactly how all these pieces fit together.
All right, let's just dive right into our macro to micro diagnostic for today. First, we'll cover the Treasury tantrum. Second, consumer and freight realities. Third, the liquidation ripple effect. Fourth, the AI bottleneck paradox. Fifth, safe havens and anomalies. And finally, number 6, catalysts to watch next. Starting things off with part 1, the Treasury tantrum.
There is so much tension in the bond market right now. The government actually stepped in to try and stabilize things. Secretary Besson announced a massive intervention of over $4 billion in long-dated bond buybacks. And sure, initially yields temporarily fell, but then we saw a really sharp reversal. Within 24 hours, yields just resumed their upward march, hitting 4.7% for the 10-year and 5.25% for the 30-year. Essentially, treasuries are kind of losing their historical safe haven status, totally failing to rally even in moments of stress. So what's driving this? Well, it's the sheer gravitational pull of one massive number, $40 trillion. That is the U.S. national debt milestone, and it is basically acting as a giant concrete ceiling on the broader market. When you combine our post-pandemic borrowing with incredibly sticky inflation and all this heavy corporate borrowing tied to the AI boom, it creates a structural pull that even multi-billion-dollar interventions are struggling to overcome.
Moving on to part 2, let's check in on consumer and freight realities.
We are seeing a really stark reality check in the retail space right now. On one hand, you've got Walmart, which is historically a huge consumer bellwether, dropping a painful 9.2%, making it the absolute worst performer in the Dow. Why? Mostly because of heavily cautious physical store spending by Americans and slowing comparable store sales. But on the flip side, you have Amazon actively trying to outrun these headwinds. They are attempting to boost their North America operating margins from 6.9% to a projected 9.4% by 2027, mainly through ultra-fast, very expensive delivery tech. And making things so much harder for these retailers is what's happening in the energy market. We're facing a looming freight shock. Diesel prices have surged nearly 50% year over year to about $5.50 a gallon. Even more concerning, the crack spread, which, if you don't know, is a major indicator of refining profitability and supply stress, has hit a record of over $102 a barrel. You have to remember, diesel powers 70% of freight, rail, agriculture, and construction. And get this, it's all happening right as the peak U.S. farming harvest season approaches. That threatens to aggressively restoke that consumer inflation we just talked about. So naturally, this is turning into an absolute logistical war. Amazon is throwing massive money at their prime air drone infrastructure, aiming to hit 500 cities by the end of 2026 just to offset these macro freight costs. But the incumbents are definitely not standing still. Walmart has already clocked 1 million drone deliveries with a 23-minute average, and FedEx is rolling out definite time same-day delivery. Growing sales volume alone. All right, part 3, the liquidation ripple effect. This is where the dominoes really started falling, and it actually kicked off in the biotech sector. Moderna partnered with Merck, combining an mRNA vaccine with the drug Keytruda. And the science here was a resounding success. A trial of 1,100 patients showed superior prevention of melanoma recurrence compared to just using Keytruda alone. This is absolutely massive. We are talking about the first true phase 3 trial success for a cancer vaccine. And honestly, the market shock was just as massive as the medical one. Wall Street was caught completely off guard. Moderna shares experienced a historic, explosive 177% stock surge in a single trading session. Now here is where it gets crazy. Let's look at the violent domino effect that 177% surge triggered across the broader market. Prior to the announcement, short interest on Moderna was sitting at a really heavy 13.7%. That was the trap. When the stock skyrocketed, it inflicted a staggering $5.5 billion in paper losses on those short sellers. That initiated the margin call. Hedge funds were suddenly forced into rapid degrossing, which basically means they had to frantically raise cash to cover their catastrophic losses. And how do you raise cash when you're panicking? You sell your highest conviction, most liquid assets. In today's market, that means liquidating top-tier AI and infrastructure stocks. According to Goldman Sachs, this hedge fund degrossing was actually a primary driver for the broader Nasdaq's underperformance that day.
Which brings us right to part 4, the AI bottleneck paradox.
Objectively speaking, AI infrastructure is hitting a massive physical wall right now. Data centers are suddenly turning from an economic boom into a potent political liability. Across the country, the pushback is real. In Pennsylvania, the governor just revoked fast-track grid connections, basically telling data centers they have to bring their own power. New York enacted a strict one-year moratorium on them. Texas initiated a really rigorous industry audit. The primary beneficiaries of all this political gridlock are actually companies that already own existing physical power plants, while the tech giants are left scrambling for megawatts. Now, combine that physical gridlock with the financial reality of the ultimate AI anchor, NVIDIA. NVIDIA is a total beast. They make up 7.6% of the S&P 500 with a market cap of over $5 trillion. But to really understand their earnings, we need to know what a triple play is. This is basically the holy grail of earnings reports. It's when a company beats earnings per share estimates, beats revenue estimates, and raises future guidance. NVIDIA has managed to achieve this a mind-bending 14 times in the last 20 quarters.
But here is the paradox. During NVIDIA's last 3 consecutive triple plays, the stock actually finished down on the day of reporting. Think about that. This tells us that NVIDIA is priced for sheer perfection right now. Merely delivering a phenomenal triple play is no longer sufficient to generate a post-earnings boost. The bar is just impossibly high. Let's shift gears to part 5, safe havens and anomalies. With all this margin call chaos and a failing bond market, we are seeing some totally wild extremes in where capital is running. On one hand, money is chasing digital assets. Bitcoin pushed up nearly 5% to around $78,000, its highest intraday level since early June. This was directly catalyzed by former President Trump meeting with digital currency leaders to urge passage of the Clarity Act, which injected a massive industry-friendly legislative tailwind. Conversely, across the globe, capital is flocking to strictly state-controlled Chinese tech IPOs. Mainland China debuts over $100 million are averaging staggering 345% first-day gains. Companies like CXMT and Unitree Robotics are seeing 400 to 500% pops. The strict state control over the IPO process there creates a perception of ultra-high-quality firms, and it's triggering this frenzied domestic demand that absolutely dwarfs major U.S. debuts right now. Finally, let's wrap up with part 6, catalysts to watch next. So, how do we make sense of all this going into next week? Here is your watch list of leading indicators. First, check the consumer baseline. Watch the remaining retail earnings, like BJ's Wholesale. We really need to know if Walmart's severe drop was just a company-specific execution failure or if it's proof of systemic consumer exhaustion. Second, the macro rates. Monitor Fed Chair Kevin Warsh's upcoming keynote at Jackson Hole. We need to see if that $40 trillion debt gravity is going to keep overpowering Treasury buybacks. And finally, the tech anchor. We have to watch NVIDIA's post-market earnings to see if they can finally reignite the fundamental AI trade that hedge funds were forced to liquidate during that massive biotech short squeeze. So this brings us to the ultimate question. We've seen how interconnected this whole ecosystem is, right? We've seen how a cancer vaccine can literally trigger an AI sell-off, and how diesel prices can drag down the Dow. Will the sheer gravity of our national debt overpower every intervention we try, or can the tech sector somehow push through its physical and financial bottlenecks to reignite the trade? I'll leave you with this final thought to ponder. In a market ecosystem this incredibly intertwined, where exactly do you think the next domino is going to fall?